The Federal Reserve finally blinked and announced a pause to their rate hikes. And they told us what's coming next. Number one, prices are never going back down to where they were prior to 2020. Number two, the reverse repo facility will be used to help refill the government's treasury general account. And number three, the big one here, Jerome Powell was asked specifically about the deteriorating financial position of the United States with their high deficits and high debt. And he was asked if the Fed would finance government debt. And Powell explicitly said very clearly, no, under no circumstance. This is huge if true. First, I'd like to tell you about today's sponsor, I Trust Capital. Today, people are concerned about the purchasing power of their dollars being eroded due to inflation. They're concerned about the returns they're getting on their traditional portfolios, things like stocks and bonds. Many people want to be able to purchase investments that will preserve their purchasing power, things like gold, silver, Bitcoin, ways to store the value of your money without being exposed to the dollar. What's the problem with this? The problem is that most people have most of their wealth in their 401ks, their employer's retirement accounts. And these accounts do not allow people to buy gold, silver, or Bitcoin. Some of them allow access to ETFs that have exposure to these prices. But number one, you're introducing many layers of counterparty risk. And number two, you don't actually own the asset itself. That's where I Trust Capital comes in. I Trust Capital allows you to open up actual retirement accounts, IRAs, traditional and Roth. You can even roll over funds from a previous employer's retirement account to fund this. You can buy gold, you can buy silver, you can buy Bitcoin and even other cryptocurrencies with I Trust Capital. And if you sign up with my link in the description below, you'll get $100 worth of Bitcoin as a sign-up bonus for opening the account. So first, let's take a look at prices and why prices are never going to go back down to the level they were at prior to 2020. This is a chart of the total amount of money in the system by year. We can see prior to all the spending and borrowing that happened in 2020, the total money supply was around $15 trillion. At the peak of all the money printing in April of 2022, the total money supply had reached a mind-boggling 22 trillion, which means that in a little over 2 years, the total money supply in the United States increased by just about 50%. That is a staggering increase in the money supply. This was the main driver of inflation as that new money that was printed worked its way throughout the economy, bidding up the prices of goods and services. Since this money supply peaked, it has been trending down, and the rate at which the money supply has been decreasing is the fastest since the Great Depression. But in order for prices to actually get back down to the same level they were at before all the money printing started, we would need to see the money supply also get back down to where it was. The reason we know this is not going to happen is because the Federal Reserve is specifically targeting 2% inflation, which they always have, and they will continue to do into the future. Now, definitions are important, so let me be very clear here. When prices are rising, that means we have inflation. Inflation is simply the measurement of the rate of change in prices. So as we see inflation move from 9% to 7% to 5% to 4%, all the way down to 2%, that means the inflation rate is falling, not prices. So if inflation gets back down to 2%, where it was for a very long time prior to 2020, that doesn't mean prices go back down to where they were prior to 2020. It just means the rate at which prices are increasing is the same as the rate in which prices were increasing prior to 2020. And given the fact that the inflation rate has now reached 4% and the Federal Reserve has already taken their foot off the brake, and they did not raise rates again. Even though they say they're probably going to raise rates again in the future, it's becoming more and more unlikely that we will see a significant drop in prices, especially back down to where they used to be. Powell was also questioned about the fact that they currently have forecasted a drop in interest rates in the future while the inflation rate is still above their target. And the answer was actually pretty interesting that he gave. Right now, interest rates are at a little over 5%, whereas the official inflation rate came in at 4%. That means the real interest rate is, let's say, 1%, just for round numbers. Because if you're losing 4% a year of your purchasing power, but you're gaining 5% back in your return from the interest rate, that means your purchasing power increases by 1%. So interest rates are positive from a real perspective, whereas for a long time they were negative from a real perspective. The Federal Reserve does anticipate the inflation rate will continue to drop from here over the next year or two, finally getting back down to their 2% target, which means that if inflation goes from 4% to 3%, then that would give them room to drop interest rates from 5% to 4% and maintain the exact same real interest rate. Because if interest rates go down to 4% and the inflation rate goes down to 3%, then the difference between the two is still 1%. So you're losing 3% of your purchasing power to inflation, but you're gaining 4% in real dollars, which means your purchasing power is increasing by 1%, the same as before, even though interest rates were cut. He indicated that the reason why they would do this is to continue tightening and to bring inflation down with trying to not over tighten at the same time. So they'd be targeting real interest rates being positive, which means they may have to cut nominal rates. Powell was also questioned about the reverse repo facility and how that may be used as a tool to assist with government borrowing as the Treasury General account needs to be refilled. As I've pointed out many times before, the Treasury General account was drained while the government was trying to figure out what the solution to the debt ceiling would be. Janet Yellen loves to have this account around the $500 to $600 billion mark, which means just to refill their checking account, which is what the Treasury General account is, it's the government's checking account, just to refill it back up to the level she likes to keep it at, they're gonna have to borrow $500 billion. But that's just to refill the account. That's not any of the additional spending that they have to do now that the debt ceiling is resolved and now that spending is resuming, which means that over the coming quarters, the government is going to have to borrow like $1 trillion. Many people have said this is going to be a major source of strain on liquidity in financial markets, but that's not actually true. Not at first anyway. Over the last couple of years, major amounts of deposits have flooded into a facility at the Federal Reserve called the reverse repo facility. And for about the last year, the amount in the reverse repo facility has fluctuated in between $2 and $2.5 trillion. This is a facility that acts as kind of an overflow for deposits in the system, where financial institutions can get a fantastic risk-free return on their money. And now money markets are passing a lot of that through to investors. Specifically, the Federal Reserve is currently paying 5.05% on all balances in the reverse repo facility. So the question is, why would those $2 trillion ever leave the reverse repo facility when they're getting paid over 5% actually completely risk-free? Well, the answer is when regular interest rates that carry some amount of risk become attractive enough, then some of that money will be pulled from the reverse repo facility and lent out. When that reward gets high enough, the risk becomes worth it. And as government borrowing accelerates, what that essentially means is that a bigger supply of bonds hits the market. All else being equal, when more things are being sold, it pushes down the price. With bonds, when prices go down, interest rates go up. So as the government has to borrow $500 billion to $1 trillion over the coming months, that will take interest rates, especially short-term rates, even higher. So without the Federal Reserve having to do anything to the rate that they're paying into the reverse repo facility, money will naturally start to come out of that facility and be lent to the government instead to take advantage of the 5.5% or maybe 6% rates. And keep in mind, there's $2 trillion in this facility right now. So at least for now, there's no strain on the system in terms of liquidity. There's plenty of money. It's just a matter of how high will rates go before that liquidity becomes available. So short term, we know this isn't a problem, but the real thing, the big shocker here was what Powell said about the long term. He was asked directly about the fiscal position of the United States, ballooning deficits, massive debt pile, increasing government spending. And he stated quite clearly that he thinks that the financial position that the United States is in right now and the direction they're headed fiscally is unsustainable. He used that word, unsustainable. And when he was asked whether the Federal Reserve would help finance some of the debt, very explicitly, Powell said, under no circumstances. Let me play it for you right now.
I will say, and many of my predecessors have said, that we are on an unsustainable fiscal path, and that needs to be addressed over time. But I think trying to get into that with lawmakers would be kind of inappropriate, given our independence and our need to stick to our knitting.
Is there any conversation then about the Federal Reserve financing some of that debt that we're seeing coming down the pike?
No, under no circumstances.
Under no circumstances, silence. Now, the reason why this is such a big deal is there's two reasons for it. Number one, if this is true, it's a massive departure from the role the Federal Reserve has played in past crises. Obviously, the Federal Reserve does not engage in outright debt monetization because it is illegal. They are not legally allowed to directly give money or loan money to the government. The only thing they're allowed to do is buy existing government debt from banks, from the open market. And so during 2020 and during the Great Financial Crisis, the way that debt monetization happened was indirectly. And so it's very possible that Powell is just saying, no, we will not directly finance the government's debt because that's illegal. The Fed is currently not allowed to do that. So we will not just print money and loan it to the government and help them finance their debt. But even though they haven't done it directly, they have indirectly done debt monetization. That's what led to the initial balance sheet explosion in 2008, the subsequent balance sheet rises all throughout the QE phases, and the most recent balance sheet explosion starting in 2020. They're printing money, buying government debt. That indirectly goes to loaning the government money at below market interest rates. That is financing their debt. So Powell may have just been saying we can't do it directly, absolutely not. But it sounded more like he was saying even indirectly, we are not going to do that because the path that the government is on now is unsustainable. So we will not participate in helping that. And if that is what he meant, then it almost certainly means the Federal Reserve will lose its independence in the future. Many people talk about the Federal Reserve's political independence and say they're not actually politically independent, but that's because they think independence means political independence from the government, like serving the government's needs. That's not what independence means. The Fed exists solely because of the Federal Reserve Act, and its mandates that it operates under are given to them by Congress. What its political independence means is that it is not allowed to do things on a day-to-day basis or even an election to an election basis based on which party is in power. They're only allowed to do things that operate under their guidance given to them by Congress. And given the fact that their mandate includes stable prices and maximum employment and also financial stability of the financial system, if they see that the federal government is on an unsustainable path with their fiscal deficits, then it would be against their mandate to assist the government in continuing down that path, which means that they're tightening, raising rates, and letting their balance sheet bleed off is on a crash course with government spending. To the extent that this happens, we already know that what it means the government is on an unsustainable path means that at some point they won't be able to afford the interest on their debt. That's all it means. $32 trillion worth of debt, they're borrowing more and more every year, and the interest rates on that debt is skyrocketing quickly. Not only that, but all of their other expenses are accelerating extremely rapidly as well. At that point, there will be a financial crisis when the federal government can no longer afford the interest on its debt. In past financial crises, the Fed has printed in order to cover it. But Powell may have been signaling here, we will not do that next time. We won't bail the federal government out. And if the Fed tries to stick to that, mark my words, the Federal Reserve Act will be rewritten, the Federal Reserve will be folded underneath the direction of the Treasury, and it will lose all political independence. It will become solely a tool for government spending. Remember, the Fed exists only because of Congress, and it only acts under the specific direction of Congress. And if the existence of the federal government is threatened by the separation that Congress has given to Fed, you can bet your last dollar that Congress will no longer allow that separation to exist. And when Congress has full control over the money printer, the inflation we've seen over the last couple of years will look like a warm memory that we will wish to return to. And finally, if you want real financial education, real financial literacy, learn about all the ways that you can protect yourself, your finances against this inflation, the deflation, the coming financial storms, crashes, check out Heresy Financial University, my membership program where you get access to the entire training library and all future courses that launch on my platform. Check it out, linked in the description below. As always, thanks so much for watching. Have a great day.